Charlie Munger and Warren Buffett always say that the first 100,000 is the hardest to make, right? Once you make your first 100,000, you can let your money do the work for you.
I think it might have been the worst year in the history of the 60/40 portfolio, or at least for the past couple decades.
There are a few things where you could lose 100% of your money, including but not limited to options, shorting a stock, buying a levered entity. Hi everyone, you have John here. Nick is actually with me together in person.
Filming in person.
We were busy at work with Megan building the website, so we figured we'd take this opportunity to film an episode together in person.
One thing we wanted to do while we were together is just talk casually and talk about some of the principles of investing, some of the things just from all the different videos we created at this point in time, putting it together and thinking about what are some of the interesting conclusions from all these different videos.
It's obviously challenging because we've done investing for essentially our entire careers. So it's really hard to distill all the lessons that we've learned into a few bullet points. But I think instead of trying to capture everything, we can maybe just talk about a few things that we've learned.
Yeah.
And some of these will be good callbacks to videos we've already done and discussed.
Sounds great. One of the first principles from some of our prior videos and just from our experience is investing at its core is like starting a business or running a business, which is you want to find low competition, because in those environments, that's where you can actually succeed. So I think we talked about this in some of our videos, one example being Venkata, who spends his day job, so 12 plus hours a day, working in stock investing. But for his personal investments, he spends all his time in real estate. And a big part of that is he thinks the competition there is less intense than the stock market. And part of that, I'm sure, is just his experience, and similar to our experience working in stocks, it's a pretty competitive field.
Yeah, I think if you look at the history of the industry of finance, there are a lot of really good examples of this too. So Nick and I both work for various private equity firms. And one of the main reasons why private equity was able to do so well over the past few decades is because not only are they good at financial engineering, but they're also really good at finding exclusive deals. Because if you find an exclusive deal, you're not bidding against many different parties. You're able to get a much better purchase price and ultimately much better return. So I think that's another example of why you want to enter industries where there's not a lot of competition.
Yeah.
The good news is, in the past, other asset classes like private equity, venture capital, or hedge funds were basically reserved for an exclusive class of people. But over the years, a lot of these firms have realized that it's important to involve investors of all different sizes. So they started lowering the minimums, and especially a lot of the big private equity firms are actually trying to actively raise capital from regular investors like you or I. So hopefully in the future, it'll be much easier for us to invest in funds like that.
Yeah, and it brings up an interesting point, which is everything kind of goes through these cycles over time, right? Which is as more people are able to access certain investments, it becomes more competitive. So you kind of see this in the investing and finance industry. You have to keep on learning and keep on improving and keep on finding new types of investments, because otherwise the returns start to get competed out. So I think it's just one of those principles where you can't get set on a specific type of investment, because in that scenario, it starts to become more competitive and you start to lose your edge over time.
Yeah. I think that's also a great segue into our next point, which is, as Nick mentioned, we go through these cycles, right? For example, right before the dot-com bubble, there was a decade where venture capital was consistently returning 30 to 40%. And then we had a period where venture fell out of favor. Obviously, the dot-com bubble had a lot to do with it, but there was a period where venture capital returns weren't that great.
Yeah.
And then, of course, over the past decade or so, venture capital picked up again, right? So you have these cycles. I think the second important lesson to learn from this is as you navigate these cycles, it's really important to find downside protection.
Yep.
And we've talked about this in some of our videos too. For example, with the music school, one way to get downside protection is to invest in preferred shares, right? And we talked about this in our video where if you own preferred shares, you get the equity upside, but also you get protected because you have liquidation preference. So I think that's one way where you can protect yourself against fluctuations.
Yeah, and it's not just the music schools that we happen to invest in. Venture capital as an entire asset class has adopted this preferred share structure, which we had talked about with David when we interviewed him. The founders don't actually make any money until the venture capital firms at least make their investment back. So even in a really high risk asset class, and maybe because it's a high risk asset class, people put in these structures in place to really protect that downside.
Yeah, absolutely. And from an investor's perspective, it's really attractive, right? Because you're locking in, hopefully, a rate of return, and you also get to participate in equity upside.
That's a good segue, actually, which is one way to protect from downside is the structural way of structuring investments in a preferred structure, for example. But another way is to diversify. And we talked about this a bit during our asset allocation video. But in general, if you diversify by buying uncorrelated assets, you actually create a portfolio that can withstand the downsides. A great example of this is in 2022, stocks and bonds happen to be more correlated, in which case a portfolio of stocks and bonds by themselves didn't actually provide that diversification benefit, which is why I think it might have been the worst year in the history of the 60-40 portfolio, or at least for the past couple decades.
Yeah, absolutely. And one way to get around that is to invest in other asset classes, right? For example, small businesses were not nearly as impacted.
Yeah.
Small businesses were still selling for, again, depending on the size, 3 to 5 times. And that's effectively what they were being sold at before as well. So you have different asset classes that are insulated at different times. And through diversification, over time, you can weather some of these storms. The other important thing, too, is by diversifying, you're not forced to liquidate assets when they're not doing well, right? For example, if you were forced to liquidate coming out of 2022, then you probably would have sold both your stocks and bonds at a loss, and you wouldn't have benefited from the rally over the past year or so.
Yeah, absolutely. Because stocks and bonds have pretty much come back. At least the stock market definitely has since 2022. And like you were saying, a good example of diversification in 22 was actually real estate, because real estate happened to be pretty uncorrelated, even if in theory prices go down when interest rates go up. You don't have to sell because you've locked in your existing mortgage rate. So that's an example where you're not a forced seller, so it's a pretty uncorrelated asset. So it was a pretty good addition to the portfolio in 2022 when a lot of public and liquid assets were really suffering.
Yeah, absolutely. And I think if you listen to some of the best investors in the world, some of them will tell you to concentrate your bets. But if you look at it realistically for an individual household, at the end of the day, you need liquidity, and you just don't have the same level of ability to withstand the volatility, right? And that's why we always recommend to our friends to diversify. Instead of investing in single stocks, we tend to prefer ETFs. Instead of investing in just stocks, we tend to suggest them invest in a diverse set of asset classes. Obviously, different people have different investing preferences, but that is something that we at least personally like to adhere to.
Yeah, that's right. And a lot of fund managers, they are part of a larger portfolio. What happens is someone invests in them, but you're not investing 100% of your assets with XYZ investor. The reality is you give them maybe 5% of your assets. So what happens is even if an individual investment fund runs very concentrated and has very concentrated bets, the actual pension funds, endowments investing in that fund are very diversified. So they're okay with individual investors being more concentrated.
Absolutely. We actually talked about this a little bit in the Q&A for one of our videos, where if you just Google one of the top endowment funds or one of the top foundations, you can actually see very clearly the asset breakdown. And even within each asset class, it will be diversified across different strategies. So for example, if an endowment fund is invested in hedge funds, and that's 40% of the allocation, even within that, they might be invested in macro hedge funds, long shorts, they might be invested in value-oriented funds versus growth-oriented funds, and they're getting their diversification that way. So from an investor standpoint or from a household standpoint, it's really important to keep that in mind and make that distinction.
We're not saying that every individual needs to go out and invest 1% of their net worth in here and 1% here.
Yeah.
It's just important to be relatively diversified. It's easy to do it in an easy way nowadays as well with ETFs. I think the big thing is also thinking about diversification, not just in terms of I happen to own a lot of different things, but I happen to own a lot of things that are not correlated, so they don't trade together.
Yeah. No, I think that's an excellent point, because from an individual investor's perspective, you might think, I own Google stock, I own Amazon stock, I own Meta stock, and I'm diversified across those three names. But in reality, those three names are very correlated, right?
Yes.
So when you think about your portfolio, when you think about managing your personal finances, it's really important to think, what is correlated with something else that I'm invested in. And if you choose to invest in a new asset, what does that add to my overall portfolio? Is it additive or subtractive?
Yeah. And it's also okay to run concentrated and correlated. It just means that you need to have a much longer term time horizon, because all of a sudden you run the risk of something like 2002 happening if you're very invested in tech, right? And then it takes a full decade to recover. But that's all right. It's just difference in terms of preferences.
Yeah, so that was actually a lot of really good discussion. And I think we covered a lot of topics that we've discussed in some of our prior videos. But I think one thing that really struck me as we go through some of these topics is the importance of staying invested. We have a lot of friends in a variety of different industries who are very high income earners, and they're very focused on maximizing their earnings potential within their career, which I think is very important, right? Because your earning stream is something that's recurring and is really important for building wealth. But oftentimes they neglect the asset allocation piece. Sometimes I would have conversations with friends and they would say, I have a lot of money sitting in my checkings account or sitting in my savings account that's just not generating anything, right? So if you think about some of the principles we discussed, which is don't try to time the market, the power of compounding, I think those are all pointing us to the lesson of you should just stay invested, right? Again, depending on your risk tolerance and depending on what your goals are, it can be different asset classes. If you need a lot of liquidity because you're thinking of buying an apartment, then just put it into treasuries. If you have a much longer investment horizon and you can just put the money somewhere and set it and forget it, you can look at things with longer investment horizons like real estate or private equity. But I think the one thing that we want to emphasize is it's just as important to maximize how you're allocating your personal assets as opposed to just looking at the earning stream, because that's just one facet of it.
The easiest example is we talked about this a bit on the live session last week, which is if you have $200,000 in savings and you're age 40, by the time you're Warren Buffett's age, which is age 93, in theory, if you're growing at about the 8 to 10% that the S&P grows at, that becomes over $30 million, right? I know this isn't a specific principle we had in mind to talk about today, but maybe is something worth mentioning, which is especially for a decent number of our listeners who are close to retirement age and our parents. The reality is, I think a lot of Chinese families are really focused on saving. And once you have a certain level of assets and can just let it compound, you should really just take advantage and make sure also you enjoy.
Yeah, absolutely.
Yeah. Don't worry about, saving X amount of money. Spend within reason.
Yeah.
But at this point, I think the power of compounding will actually do very strong things for your portfolio, which enables you to spend more and make sure you get what you want out of retirement.
And you can almost think about this as similar to a university endowment, right? University endowments withdraw money to fund the budget of a university every single year. But the intent is it never runs out of money, right?
Yep.
Because the idea is, I'm using round numbers here, you earn 10% per year and you pay out 5%. So you're actually still growing the pie, right? So you can view your pile of savings similar to that, where you can still take money out and not be worried about that pie or that pool depleting. The final thing, related to this topic is Charlie Munger and Warren Buffett always say that the first 100,000 is the hardest to make, right? Once you make your first 100,000, you can let your money do the work for you. And we really want to drive that point home because you've spent all this time and so much of your life building up wealth. You should just take advantage of that and stay in the market, use some of the principles we've talked about, which is diversification, downside protection, because if you let your money work for you, then it's a pretty good feeling.
Yes. I do want to be clear that we're not giving specific financial advice.
Yes, sorry.
I think what I'm always worried about whenever we make these videos is someone goes out, puts 100% of their money into some type of levered S&P or QQQ ETF, and then the market crashes. That is entirely possible. Entirely possible. But the reality is that means you have to be prepared to stomach that volatility, because over the long term, you're going to be fine. You're going to have the benefit of compounding.
Yeah. But levered instruments are dangerous.
Yes, that's a fair point. Do you want to talk about that for a moment?
Yeah. I think, there are a few things where you could lose 100% of your money, right? Including, but not limited to, options, shorting a stock, buying a levered entity or buying a levered instrument. I'm sure there are others, but when you think about leverage is great a lot of the times because it can amplify your return. That's why real estate is so powerful, because you can put 5% down, 10% down, take the rest as leverage, and as long as the value of your home goes up over time, you actually make a much higher return than whatever the home value is going up by.
Yeah.
That being said, of course, we've seen in the housing crisis what leverage can do. And I think that's a very good lesson for all of us to be careful when you use leverage.
A great example of this is options, because sometimes you can't tell that you're taking on leverage in options, but they are, at the end of the day, levered instruments, which mean you can lose 100% of your money.
Another thing that is true, but a lot of people don't realize until you actually write it out, is when you lose 50% of your money, you have to earn 100% returns to get back to where you were. If you lose 2/3 of your money, you have to triple your money to get back to where you were. So that's why preservation of capital is so important, partially because of the compounding effect, right? Once you lose your base, you need to do a lot better in terms of the compounding to get back to where you were. So again, not financial advice, but at least when I think about investing my personal wealth, I always think about, what can I do to protect the downside? Because losing the money is so much more devastating than not making enough, oftentimes.
Yeah, absolutely. Okay, I think that's probably a good pausing point. We want to also say thank you to everyone. It's been maybe 2 months now, and it's been incredible how many people we've reached and how supportive everyone's been. So thank you so much, and we'll keep on making videos, and hopefully they're helpful.
Yeah, hopefully you enjoy this longer format, and let us know if you have any questions. We love receiving your questions, whether that's in the WeChat group or during the Q&A sessions. We're limited in the amount of advice we can give you because we're not giving you investment advice. But the purpose of this channel is really to discuss our thoughts, kind of share some best practices, and really be educational, right? Ultimately, your decision is your decision. And we're not trying to encourage you to go one way or the other, but you could just view us as a resource to help you on your journey.
All right. Perfect.
Great.
Okay. Bye, guys.
Bye.